Welcome back to the Wall Street Podcast. Today, we're digging into a fresh report from Goldman Sachs research on Nike, ticker NKE. This one dropped September 25th, 2025. It's titled, Discussing Key Debates and Updating Our Trackers Ahead of F1Q Results.
That's right. And the headline number from Goldman is, well, they're maintaining their BUI rating. They've got an $85 price target, suggesting, maybe 19.3% upside from here.
Okay, a BUI rating. But the interesting part seems to be their own forecasts.
Exactly. Goldman's conviction is built on expecting things to improve sequentially, step by step. But, and this is key, their own estimates for fiscal 26, revenue down 2.5%, EPS around $1.30. That's significantly below the consensus view.
Right, that jumps out. So a BUI rating, but with pretty cautious numbers baked in. Let's unpack the key debates they flag, starting with product, innovation versus the classics.
Yeah, so for the first quarter, F1Q, they actually anticipate a modest beat on revenue and EPS. They're seeing positive signs, emerging green shoots, they call them, in consumer interest for new innovations.
Right, which ones?
Things like the Vomero and Pegasus running lines. Also the women's category focus. Think the planned Skims collaboration. That's getting attention.
But what about the established franchises?
Well, that's the flip side. They acknowledge that managing those big franchises, like resetting the Dunk, for example, that's going to continue to be a drag on sales, at least through the first half of this fiscal year.
Okay, product mix is one challenge. Let's pivot to Greater China, always a volatile region. What are the trackers showing there?
Still volatile is the short answer.
Sure.
Trackers are pretty muted. The Baidu index is down year-to-date. E-commerce sales growth has moderated.
So not great sign.
Not overtly positive on the surface, but Goldman's looking at the sequential change. They expect Nike's efforts to manage down inventory will drive improvement from the prior quarter. So they're modeling F1Q revenue in China down about 13.7% year-over-year ex FX. Which sounds bad, but it's better than the minus 20% they saw in F4Q.
Right, so improvement off a low base. Understood. And their channel strategy, it seems like they're trying to do two things at once, premium and value.
That's a good way to put it. It's definitely two-pronged. First, premiumization in their direct-to-consumer, so Nike.com. Average prices there are actually up year-over-year. Why? Because they're pulling back on markdowns, reducing discount breadth.
Okay, less stuff on sale on the main site.
Exactly. But then, second prong, they are expanding into value channels. Think Amazon. They've doubled the assortment there since launch, but it's very targeted. 98% of that product is under $100.
Okay, that makes sense. Which brings us back to that sort of valuation disconnect we noted at the start. If Goldman is constructive enough for a DUI, why are their own FY26 numbers so much lower than what other analysts expect?
It reflects pragmatism about the current headwinds. The lower numbers factor in those franchise resets we mentioned, the macro slowdown risks, particularly in China, and just overall competitive intensity.
So the estimates are grounded in today's reality.
Right. But the BUI thesis is forward-looking. It's based on the expectation of that sequential fundamental improvement materializing over, say, the next year or so. They're essentially targeting a specific valuation multiple, a 26.5x EBITDA on future earnings Q5 to Q8 out.
Got it. Beyond the pure financials, what other metrics are they pointing to for brand health? How is Nike doing versus competitors right now?
They highlighted a few things. Net purchase intent for the main Nike brand has apparently improved recently. And interestingly, search data shows newer innovations like Vomero are getting more searches than classics like the Air Jordan 1 or Dunk right now.
That is interesting. A shift in consumer focus, maybe.
Could be. Plus, they tracked foot traffic in Nike factory stores for August and September. And the data showed Nike outpacing most of its footwear peers during that period.
Okay, some positive signs on brand momentum. Let's talk inventory risk, though. Inventories are still elevated across the industry. What's the risk for Nike sticking to this higher price, lower markdown strategy on Nike.com in this environment?
It's definitely a balancing act. The strategy helps average unit revenue, AUR, and overall margin health. That's the goal. The risk is pushing prices too high, too fast, and hitting a wall with consumer perception of value.
And are they seeing any signs of that?
Yes. The report notes a recent slight decline in consumer perception of Nike's price to value. So if the markdown environment doesn't continue to ease as they expect, or if consumers balk at prices, that could put pressure on their digital revenue growth short term.
So thinking about the average person listening, what does this strategy shift really mean for you when you're buying sneakers?
Well, it means you're probably seeing fewer deep discounts directly on Nike.com. That space is being reserved more for full-price, newer items.
Mm.
But the expansion into places like Amazon means they're still trying to capture shoppers looking for value, just elsewhere. It's segmenting where you shop based on what you're willing to pay.
A clear split, which leads to our final thought here. The big unknown, the key downside risk Goldman seems to hint at, is price elasticity. Just how much are consumers willing to pay? Especially for innovation, as prices continue to potentially rise, maybe even with higher tariffs looming down the road, how elastic is that core athletic customer, really? Something to consider. We'll leave it there for this deep dive.